next is the classification of finance. There are several classifications in finance. The first one is family finance. Family finance means how a family manage a finance or how a family utilize their income. So take an example, like you have 5 members in your family, your mother, your brother, your father, you and your little sister. So your brother, father and mother, they all are doing their job. Like your father is doing a business, so this business is the source of income, and your mother and brother is doing job, so these are their source of income. So this source of income is the collection of fund from the family business. And utilization means how you are going to use this fund. How? Like you need to pay the utility bills and you need to pay the admission fees. These are the main expenditure of your family. It will depend on your priority basis. So it's your decision how you will use it to concise your expenditure and to save your income. This is all about the family finance. And then it is public or government finance. Here there is a little different. Government has a little different financial management. Over here the concept is same, how they will collect the fund and how they will utilize the fund. So here how they collect the fund. They collect the fund from income tax, then VAT, then import and export customs, then saving expenditures, T-bills, etc. From this, government has collected funds, and how they use it for the government employee salary, then government schools, colleges, universities, then construction the roads, bridges. So they are using this fund for maintaining those government works. So this is how government is collecting their funds and then they are utilizing this fund. And if government needs money or if their fund is not available for the construction work or any kind of government work, then they have to take foreign loans from the international banks like IDB, then ADP. But this type of international funds requires many conditions, so government try to avoid this type of things. And the next one is international finance. This is very crucial part because it shows the concise relationship between the trade deficiency and remittance. What is trade deficiency? Let me give you an example. Like Bangladesh normally imports several things. From there, they import like cosmetics, then any other garments related products, then frozen food. They import a lot about this. But whenever it exports this, Bangladesh only exports the ready-made garments things, then any other type raw materials. But if you compare this import and export products, Bangladesh mainly imported much more rather than the export. That's why deficiency occurs when imports is greater than the exports. These imports makes our country deficiency. So how government or how a country covered this deficiency? They covered this deficiency by remittance. So remittance means remittance is sent by foreign workers mostly to their home country. So here how they collect funds? They collect funds through remittance. And how they utilize their fund? They utilize their fund by creating the trade deficiency. Then the finance of non-profit organization. Non-profit organization is nothing but the NGOs or the orphanage or the old home, you know. So this type of things doesn't need any profit. So they just need money to run. They also need money to run. But from where they will get money? They will get money from their donation, because there are so very big companies or rich people are there to develop their image or reputation by donating this type of organization. So when they donate a certain amount of money, this will be their collection of fund. So how they will utilize that? They will utilize it by improving their construction work, by improving their environment, by improving the people's food system, then delivery system, etc. So main concept on finance is it will shows the relationship between the utilization of fund, how you will use it, and then the collection of fund, how you will collect the fund. So different organization or different sector may vary with this type of things, but concept will be the same. So now we will start the business finance. Business finance is all about the same with the finance, but this is only for the business purpose. Like your required fund will be your business purpose only, then available source will be your business purpose, then your available source cost, then minimum cost, then how you will use this to maximize your profit. This all will be only for the business purpose. So this is all about the business finance. So business organizations has three types, which is sole proprietorship, then partnership business, then joint stock company. Sole proprietorship business is one kind of, if I say straightforward, then you will earn by your own, you will enjoy your profit by your own from your business, and finally you will have to face your business loss by your own. So this is called the sole proprietorship business. Then the partnership business. Partnership business is completely opposite. Why is that? Sole proprietorship is all depend on by yourself. You will do it by yourself, you will earn it, you will enjoy it, and you will face the loss. All the things is by your own. But partnership is all about everything will be distributed among the all partners you have. For example, if your business is a partnership business, then you have to earn all your profits or all your sales by your partners. Then you have to enjoy your profits and distribute these profits among the partners. And if you face any loss, this loss will be repaired by your partners. So very interesting part is joint stock company. Joint stock company is slightly different from the partnership business and the sole proprietorship business. Why is that? Because joint stock company has to take the government approval before it starts. So before giving approval by the government will analyze the minimum amount of capital the directors have, then the identification of the directors, and many other various documentations. After giving the permission or approval, a company will distribute a expected amount of money with a small portion of equal amount to the shareholders, so that they can earn money from their shareholders. For example, if the company have 1 lakh shares with 1000 taka, then that company has to have 100 million capital. Then they can approve that 1 lakh share in the share market. So then small business holders or any kind of business holders can purchase this type of shares, and they have, I mean to say, shareholders can sell these shares to get the cash in the share market. Also, this type of company can get or can collect money from debenture holders and from the bond holders. How is that? They will collect money by giving a certain amount of interest rate to the debenture holders or to the bond holders, because bond holders or debenture holders are not the owners of the company, where the shareholders are the owners of the company. So now come to the bank and financial institution. So how bank and financial institution collect their funds and utilize their funds. How is that? Let me give you an example. Over there, from here collection, I will write it down. And now it is the utilization. How they will collect it? By creating deposit account. Bank will give a certain amount of interest rate if anyone deposit a certain amount of money. For example, you want to deposit like X amount of money. Let's take it. X amount of taka you want to deposit. So your bank said, if you deposit X amount of taka, then they will give the 5% interest rate. They will give the 5% interest rate. So now, how they will utilize it? They will utilize it by giving the loan to other people. Like you are getting the 5% interest rate from the bank. So, for example, I want to take loan from the bank. So bank said, if you want to take loan from me, then you have to give the 10% interest rate. So I have agreed. Then there is a 5% difference interest rate, right? So this 5% is the bank's profit. You are giving 5% interest rate from the bank, then I have to give 10% interest rate to the bank. So this 5% difference will be the income of the bank. So how they will collect the fund? By creating the depository account. And how they will utilize it? They will utilize it by giving the loan.